Welcome to this explainer. Okay, so if you've ever found yourself doom scrolling through real estate listings at 2 a.m., staring at a $500,000 house with like 2003 laminate countertops and beige carpets, wondering if you somehow missed a massive career promotion or if the entire housing market has just collectively lost its mind, well, you are definitely in the right place. Today, we're validating that exact frustration. Our goal here is to completely ignore what a mortgage broker says you're approved for. Instead, we're going to use raw data to figure out who can actually afford a $500,000 house without, completely destroying their life and mental health. Okay, let's dive into this. Who can actually afford a $500,000 house? Because right now, there is a massive and quite frankly uncomfortable disconnect happening. In dozens of U.S. markets, $500K is just the baseline. It doesn't get you a sprawling mansion, it gets you a 1,200 square foot box. Meanwhile, the median household income in America is hovering right around $84,000. Think about that. We are asking people making $84,000 a year to somehow afford homes that cost literally 6 times their annual income. Which brings us to Section 1, the setup, the $500,000 starter home myth. Everywhere you look, somebody is telling you that you can afford a home, right? Your parents bought a house on less, influencers are constantly telling you to buy with absolutely no money down, and hey, the bank approved you. But here's the truth. Society is largely lying to prospective buyers about what affordable actually means. Let's look at the very first massive hurdle, the down payment. The old standard rule for buying a house is putting 20% down. On a $500,000 house, that is a cool $100,000 in cash. But the median savings account in America, it has roughly $8,000 in it. The average American isn't just a little bit short here. They are exactly $92,000 short of a traditional down payment. Now, you might be thinking, well, I'll just save up for it. And that brings us to this number, 12. 12 is the amount of years it would literally take you to save up that $100,000 down payment if you make the median $84,000 salary and miraculously manage to save 10% of your gross income every single year. Oh, and by the way, that 12-year timeline assumes that housing prices never go up again, which, based on history, is a highly, highly unlikely scenario. All right, moving on to Section 2, the breakdown. Let's get into the real monthly math. Because people obviously don't want to wait 12 years. They usually put down 10% instead, which is $50,000, and they take out a $450,000 loan at around a 6 to 7% interest rate. Let's forensically tear down the true monthly cost here. Your baseline principal and interest on that loan is about $2,850. But we really need to talk about the hidden killers: taxes, insurance, and maintenance. First up, property taxes. A conservative estimate puts you at roughly $500 a month. Next, insurance. Thanks to climate impacts, homeowners insurance has completely skyrocketed. Whether you are in a flood zone or tornado alley, you're looking at least $300 a month. Then we have maintenance. The general rule of thumb is 1% of the home's value per year. For a $500,000 house, that's $5,000 annually, or $417 every single month, just sitting there waiting for the water heater to inevitably explode. Finally, because you didn't put the full 20% down, you get hit with PMI, private mortgage insurance. It's essentially a $300 poverty tax that protects the bank, not you. Add it all up, and your total isn't $2,850. It's a crushing $4,367 every single month. Now, what's really interesting about looking at this breakdown is how it visualizes the pain. You can see exactly how maintenance, property taxes, and insurance dramatically inflate your housing costs. Those 3 pieces alone add over $1,200 to your monthly burden. And remember, that $1,200 assumes nothing major breaks, and your HOA doesn't just randomly send you a $3,000 special assessment bill to repay the neighborhood. So if we reverse engineer this math, it paints a pretty grim picture. Traditional financial advisors will tell you that you shouldn't spend more than 28% of your gross income on housing. To comfortably afford $4,367 a month under that rule, you'd need a salary of $187,000. Even under a bank's incredibly lenient 43% debt-to-income rule, you still need to be making $150,000. But look at the median income. It's $84,000. Only 10 to 20% of households actually make $150,000 or more. Under any reasonable financial standard, 80% of households absolutely cannot afford this house. Which brings us to Section 3, the house poor reality. Let's meet the Johnsons. So, who exactly is buying these houses? Let's move away from the abstract math and look at human reality. Meet our hypothetical household, the Johnsons. They're dual-income professionals making a combined $160,000 a year.
That puts them solidly in the upper middle class. By all societal standards, they should be incredibly comfortable, right? Well, let's see what actually happens when they buy this house. A $160,000 gross salary sounds amazing until the IRS shows up. After taxes and just modest 401k contributions, their monthly take-home pay drops to $9,500. Instantly, 46% of that, so $4,367, is swallowed whole by the house. They are left with just $5,133 for literally everything else in their life. Let's rapid fire through those essential living expenses to see where that money goes. 2 car payments to commute from the suburbs, that's $800. Groceries to feed the family, another $800. Student loans for the degrees that got them these jobs, $600. Utilities for the bigger house, $450. Health insurance, $400. Boom. Suddenly, their remaining budget shrinks down to a measly $1,533. And out of that tiny amount, they still have to figure out how to pay for car insurance, gas, clothes, kids' activities, medical copays, and somehow magically build an emergency fund. Notice how incredibly quickly a house poor budget collapses when, normal life happens. Month 1, the mortgage is paid. It's a bit tight, but they manage. Month 4, the car needs new brakes. That's $800 they just don't have, so it goes straight on a credit card. Month 7, it's the dead of July and the HVAC dies. That $3,500 repair bill, yeah, that has to be financed too. This is the ultimate cautionary tale of the Johnsons. When you are stretched this thin, every single unexpected expense becomes a massive financial crisis. Let's look at Section 4. The system is rigged. If you are feeling frustrated right now, let me tell you, your feelings are entirely validated by the numbers. This math is practically impossible for the median earner. And the harsh truth? The real estate system absolutely does not care. But you shouldn't blame yourself, and this brilliantly illustrates why. Since 1990, home prices have skyrocketed by 400%, while median household income has only crept up 180%. The problem isn't your personal budgeting. It really isn't because you buy avocado toast or refuse to grind away at a side hustle. You literally cannot budget your way out of a structural affordability crisis. The math simply does not work. The crucial point here is simple. The system is designed to get you into the house, not to ensure you can comfortably afford it. Think about the incentives at play for a second. Sellers want the highest possible prices. Real estate agents want commissions based on those high prices. Banks want to issue massive loans. Nobody, absolutely nobody in this transaction is incentivized to tap you on the shoulder and warn you that you are about to financially drown. So what do? That brings us to Section 5, redefining real wealth. Listen, if your household income is south of $140,000, it is time to give yourself permission to stop looking at houses you simply cannot afford and step right off this financial tightrope. We really need to redefine what real wealth actually means today. Step 1, it's having margin in your budget so a broken water heater doesn't ruin your entire year. Step 2, being able to invest consistently for your future. And Step 3, simply sleeping at night without financial anxiety. Real wealth isn't being trapped in a depreciating box you can barely afford to heat. It is financial freedom, it's peace of mind, and it's the ability to actually enjoy your life. Here is your core takeaway for this explainer. There is no prize for buying a house you can't afford. There is no trophy for being house poor. Do not participate in this collective financial insanity just because culture tells you renting is throwing money away. Let me be clear. Being unable to afford your mortgage, neglecting crucial maintenance, and racking up high-interest credit card debt just to survive, that is also throwing money away, just with far, far worse long-term consequences. I want to leave you with this final, somewhat provocative thought. The next time you look at a real estate listing, I want you to genuinely ask yourself, will owning this house actually improve your life, or will it just transfer all your hard-earned money to a bank while you constantly stress about property taxes and insurance hikes? Challenge yourself to make your housing decisions based on cold, hard math rather than emotion, social pressure, and a system that literally profits off your stress. Thank you so much for joining me for this explainer. And remember, sometimes the smartest move you can make is realizing the game is rigged and simply choosing not to play.